Hello, everyone. Welcome in. Hopefully, you've got your lunch or a good snack as we start by talking about some very important things on our webinar, PCORI 5500s and summer compliance updates. Thanks for joining us live. My name is Cassie Hopkins, and I help coordinate the webinars for Houseman Group. We're joined by Casey Ripstein, which might be a familiar face for some of you, our partner over at Benefit Compliance Services, also known as BCS. I'm just going to go over a couple housekeeping items with you guys and then turn it over to Casey because we have so much to get through, so many topics to cover, and we're going to be going at a really fast pace. So if you have any questions, what Casey's going to do is we're going to kind of stop after each really structured topic. And then if you want to put your questions in chat, we'll have a bit of a mini question and answer session, and then a larger one right at the end of the webinar as well, hopefully, if we have time. With that in mind, this webinar is recorded, which means that you will get a copy of the webinar emailed to you with the recording and a copy of the presentation slides. You're welcome to send that to anyone who you'd like to share it with, or if you have to hop off early, it's a great way for you to watch the full recording. This is also for HRCI and SHRM credits, so I will include that in the follow-up email as well. And with that, let me introduce a little bit about Casey. He has over 20 years of experience in employee benefits, and 15 of those years have been focused on dedicated compliance practice for large national brokerages. In his role, his leadership was central to scaling brokerage operations during periods of massive regulatory change, which, as we all are feeling, we're in one of those right now as well. His knowledge of health and welfare compliance is among the best in the nation, and his greatest skill set is a knack for making difficult topics easy to understand and apply. We're so grateful to have you here, Casey. Take it away.
Thank you, Cassie. Hopefully we can do that again. Try to make some of these things easy to follow. So what we wanted to do today is we're in July. We have some July 31st deadlines approaching, and we want to make sure everybody feels comfortable with what's required, reviewing what's been done for you. So we have the PCORI fee, which needs to be filed and paid by July 31st for certain employers. And so we'll talk about who those employers are. And then 5500s are due by the end of July for calendar year ERISA plans, which is most of the people attending this call. And then we do want to go ahead and talk about the benefit provisions that are in that budget bill. We have some benefit impacts that were included in there. Not as many as we thought we were going to get, but we have plenty to talk through. And then just some other summer updates and a look at what's ahead. So with that, we'll start with PCORI. But like Cassie said, as we go through this, if we cover some material and you still have an outstanding question, please put it in the Q&A. What I'll do is after we've talked through PCORI, I'll see if you have some PCORI questions that we can talk about real quick before we move on to 5500s. So just starting with PCORI for employers, this is a fee that's required to fund the Patient-Centered Outcomes Research Institute. And they perform clinical effectiveness research. It's funded by a temporary fee on health plans. This is only collected between 2010 and 2030. As of now, it was supposed to only be 2010 through 2020, but Congress extended it another 10 years. So we'll see if this actually sunsets in 2030 or not. But the general premise is each year on July 31st, everyone that's subject to this fee needs to file and pay, and it indexes every year. And so the fee due this year is $3.47 per covered member for your plan, or a lower amount of $3.22 if your plan year ended before October 1st last year. And short plan years don't get to prorate anything, they pay the full fee. And so basically what we're looking for is plan years ending in 2024. So I know we're tend to focused on plan year start date, the renewal date. We need to shift our focus just a little bit for purposes of this fee to when does the plan year end? So we're going to look at the plan year ending at any time in 2024. And you can see it's 347 unless it ended before October 1st, it's 322. If it's fully insured, if that plan year that ended in 2024 was fully insured with a carrier, the insurance carrier files and pays, so you don't have to worry about it. But if it was self-insured or level funded, the employer has responsibility to file and pay this fee. Also, if the employer is sponsoring a health reimbursement arrangement integrated with a fully insured medical plan, even though the insurance company is taking care of PCORI with respect to the fully insured medical plan, they have said the employer sponsoring an HRA that integrates with it also has to file and pay. But they give you a little bit of a break. Instead of paying on all covered members, they tell you just pay on all enrolled employees. You don't have to count the spouses and dependents that are enrolled. So there is a filing obligation, even if you're fully insured, if you end up with an HRA too. You have a filing obligation with respect to the HRA. Also, if you're sponsoring an ICRA, those individual coverage HRAs are becoming more and more popular. So those are more and more in the mix, and we don't want to lose sight of those as well. There are 4 approved ways to count your average covered lives to multiply your fee by. And the employer is allowed to use any of these 4 methods every year. You can choose the lowest count that is produced every year. So you don't have to pay attention to what you did last year. You don't have to commit to using the same one next year. Every year, all 4 methods are available, and the lowest count is available to be used. So the first one is just an actual count method. It's not terribly common, but you could literally have a count of covered lives on the plan every single day of the plan year and divide by the number of days in that plan year. So divide by 365 or 366. That's not very common. Usually what we're dealing with is a snapshot method. This is the idea of counting covered lives at least one day each quarter and then divide by the number of days you do a snapshot count. So most plans end up getting a monthly count from their carrier or TPA, and they do 12 counts. Uh, the special rule that applies here, though, is the date you're choosing has to be within plus or minus 3 days of the respective date you chose in the first quarter. So as you proceed to the second quarter and the third quarter and the fourth quarter, you need to make sure you're not deviating too far from the date you chose in the first quarter. So for example, if you're doing monthly counts and the monthly count is always on the first, you're good. But if one monthly count is on the first and another one is on the third, we're okay. But the next one can't be on the fifth. Even though that's within plus or minus 3 days of the third, it's not within plus or minus 3 days of the first that you did back in the first quarter. So we have to make sure we don't deviate too far from the dates that we're choosing in the first quarter as we do these snapshots in other quarters. So pretty easy rule to follow. Most of these carriers and TPAs will just give you a monthly count. They're always done on the same day, usually the first. The snapshot factor method is also available, and this can sometimes help employers that have a lot of dependents enrolled. It's the same as the snapshot method, but instead of doing a membership count, we actually count the number of employees enrolled in dependent tiers. Multiply that by a factor of 2.35. And then we add the number of employees enrolled in single coverage. So for each snapshot day that we do, let's just say we do first of the month every month, we do this count of employees enrolled in a dependent tier times 2.35, add to that number the count of employees enrolled in single coverage. And so that is how the snapshot factor method would work. And as you could see, since it really applies this factor, an assumption of on average, you would probably have about 2.35 covered people per enrolled employee with a dependent tier. If you have a lot more than that, this can help you bring that number down versus the snapshot method. HRAs and ICRAs are basically going to use this method without the 2.35 factor because we don't have to count covered dependents. The Form 5500 method can also be available if the plan year that you are filing and paying for has a 5500 being filed by the deadline that you're trying to meet for this PCORI fee. So if you are filing your 5500 for that plan year by July 31st, you could take your participant counts at the beginning of the plan year and at the end of the plan year and see if you can use that one, if it's the lowest. If you have a plan that doesn't cover dependents, you just divide that sum by 2. and come up with an average instead. But most employers offer dependent coverage too, so that doesn't usually apply. So you have all four of these available, and Houseman makes available a PCORI calculator to help you plug in all the numbers you're getting from your carrier TPA, your 5500 numbers, and come up with the lowest count from those four. In a prior iteration of that calculator, I was showing the lowest count as a whole number and then multiplying it by the fee and coming up with your fee that is due. And all of that is still intact, but a recent update we made is when we show you the lowest count, even though we don't round in the tool because the IRS has never told us we can round, one thing we did in the tool is show you on screen out to the hundredths place on that membership count. So you can see that number times the fee equals the total fee that we've been showing this whole time. So no adjustment to how much of a tax is calculated as owed. Just wanted to show you on screen with the calculator what number we multiplying that fee by, not just a whole number. So here are some simplified examples of how we would go about this. In scenario one, we have a smaller employer, 50 employees, 10 of them are enrolled in single, 40 in dependent tiers. And we're going to assume 2 enrolled per employee. So we've got 80 dependents on the plan. Our average member count is therefore 130. And we're just going to keep that static for the whole year. Like we're not going to have it fluctuating up and down. We're just going to say that's the count every month of the year. Under the actual count method, you have 130, of course. Snapshot method also comes to 130 because we don't have any deviations. Snapshot factor method is actually coming in at 104, and the 5500 method is coming in at 100 because we have 50 employees enrolled at the beginning, 50 at the end, and so 100. So in this example, snapshot factor method could have helped them, but 5500 method ultimately is the one that brings them the lowest count and the lowest cost fee. So they could pick that one. On scenario two, a little bit different. 100 employees, 75 in singles, very heavy single population, 25 in other, but we have 3 enrolled per employee, so 75 enrolled dependents. So 175 is our average member count. When you do the analysis and you go down the list, snapshot factor actually helps quite a bit here because multiplying by 2.35 is less than the 3. And so it really helps bring that number down, and the employer is free to use that result. So just some oversimplified examples to kind of show how you can do this analysis every year, use the calculator to come up with the lowest number, and report that count on your Form 720. And speaking of the Form 720, you do need to use IRS's second quarter Form 720. It's usually released in June, like mid-June. This year, they had it out early at the end of May. So we have been able to file and pay this since late May. And I'm giving some screenshot examples here of the kinds of fields you're going to be focused on because the Form 720 is an excise tax return that covers a lot of stuff. And you're really focused on one element of this form, and that's row 133. So in the beginning, you're going to mark the correct quarter that you're filing for. And then when you get down to part 2, the very first entry there is row 133, where this fee is reported. And you're not going to pay attention to rows A and B in there. Those are for fully insured plans being reported by a fully insured carrier. They are taking care of all that. So you skip those 2 rows. We're going to focus on self-insured health plans. If you had a plan year ending before October 1, you use row C, and you can see that $3.22 lower number. If you had a plan year ending on or after October 1 by December 31, then you go ahead and use row D. In this example, I'm actually showing you an employer that had a short plan year. They had a plan year that ended before October 1, 2024, and then they did a short plan year to end December 31st of 24. In that case, they're actually going to pay this fee twice this time. They're going to pay the fee under the 322 and then the fee under the $3.47 for the short plan year. And then they add them up at the end. So hopefully this provides a good example of how to do that. And then don't forget, as you get down to the end of part 2 and you move on to part 3 of the form, you have to keep repeating the total. So just keep repeating all those. Then you sign. You can do all this electronically, and you can even pay electronically. It's up to you. The Form 720V is provided at the end of the form to cut a check and mail all this, or you could do all of this online. So with that, if you have any questions, you feel free to put those in the Q&A, but the Houseman team can really help you kind of keep up with this. Okay, and what we'll do is move on to 5500s. So these can be a little like out there, like you don't see them all the time. It happens once a year and it might even be done for you, so you're just not as familiar with it. We want to kind of make sure you feel comfortable with what it covers and what should be on there. And so basically, a 5500 is a federal filing that goes to the Department of Labor to report your ERISA plans that you sponsor every year. And we only have to do this filing if we have 100 or more participants on the first day of the plan year. Um, there can be times where we have less than 100 and we do have to file. That's when we're participating in what the government calls a MEWA, or we're utilizing a trust. The government calls that a funded plan. So if we're using a trust or participating in a MEWA, the 100 mark doesn't matter. We kind of ignore that idea. But if we're not doing any of those things, we just have our own plan, and we're not using a trust, then 100 plus participants at the start of the plan year triggers a 5500 filing, and it's due 7 months after the plan year ends. Now, who's subject to ERISA? It's basically going to be all employers unless you're sponsoring a governmental or church plan. They are exempt from ERISA in the 5500. Everyone else is subject. And usually to do this count, this 100 participant count, we're usually focused on the employer paid policies, like an employer paid life or an employer paid EAP. That's going to have your highest count, and you can just focus on that one and know what your participant count is for that year. If you don't have an employer paid policy whatsoever, you just have to do a count of all of the plans that are in your wrap plan document. So you might look at, Plan 501 that we sponsor includes medical, dental, vision, life, and disability. So count up all the employees enrolled in medical, add in all the employees that enrolled in dental but don't have medical, add in all the employees that have vision but not medical or dental, and so on. So that is how you would go about doing your count. Most of the time, you have an employer paid policy like a life or EAP, though, and we could just focus on that one because we know it's basically everybody. If some plans are on their own, so you have a 501 for most of your plans and maybe a plan 502 for a couple of outliers that have a different plan year, that's a separate process. So you do your count by ERISA plan. Voluntary plan safe harbor is rare, but it is available for certain employers to exempt their benefits from ERISA if they meet the criteria you see here. And basically, the employer can't really be sponsoring it officially. They don't sponsor it in any of their written materials on their website or anything. They're basically just letting a carrier come in and talk to their employees and show them the policies, and they're letting employees make a paycheck deduction to pay the carrier, but not pre-tax. Can't be a pre-tax deduction. They would have to pay the full cost as an employee, and they would have to pay it tax. And then the employer should not get an unreasonable amount of compensation for allowing all this to happen. Something very minimal just to cover, hey, I'm letting people take work time to visit with the carrier. I'm letting the carrier come in. I'm facilitating these payroll deductions and these payments to the carrier. I need just the tiniest bit of compensation to make me whole on allowing all that stuff, but nothing over that. So this is pretty rare that a plan that you sponsor would not be subject to ERISA. Usually we are talking about ERISA plans by and large that you are sponsoring. So to go into a little bit more detail on that, it's all of your group health plans are going to be subject to ERISA, your medical and RX, and any benefits that have to integrate with medical and RX. Think your telemedicine, a fertility medicine benefit, anything like that. Dental, vision, EAP, health FSA, HRA, all group health plans. They're all subject to ERISA. Certain ancillary plans. So ERISA does delineate which ancillary plans are going to be subject to ERISA. That's your life and AD&D, your travel accident, a fully insured disability policy, indemnity plans, legal plans, and long-term care insurance. We don't have cafeteria plans and HSAs, daycare FSAs subject to ERISA. And so they don't have to be included in your 5500 filing. And a little bit of an interesting animal is disability. Um, Fully insured disability is subject to ERISA, self-insured disability is not. It's actually viewed as a payroll practice. So it sits outside of ERISA. It operates more like a sick leave policy or a PTO kind of policy rather than an insurance policy. Statutory disability is treated the same. That's treated as something that operates outside of a benefit plan, employer-sponsored arrangement. Even if the employer is facilitating the statutory disability, they consider it to be a separate thing. And then all of the other kind of fringe benefits that you see in different employer sponsoring, adoption assistance, education assistance, and you name it. All of these sit outside of ERISA, don't have to be reported. You will see on a 5500 when you look at one, there is a checkbox to report a stop loss policy. You actually don't report your stop loss. As long as your stop loss premiums are completely paid by the employer from general assets, not from plan assets, then the stop loss won't be subject to ERISA and you won't have to report it. And we strongly encourage employers always make sure the stop loss premiums are paid from general assets because stop loss is not an employee benefit. It's a cash flow protection instrument, a financial product to protect the employer's cash flow from catastrophic claims. And so there's not really a good way to make this an ERISA employee benefit. It's an employer financial protection product. So we want to keep it out of ERISA. When you get to completing the 5500 and you can see your old 5500s anytime you want, I've given you the link up here. There's a main body and then there's some schedules that you attach. And for the main body, it's pretty self-explanatory. You're mainly just going to indicate whether premiums and benefits are paid from insurance, general assets of the employer, maybe a mix of both. If you're utilizing a trust, you will mark that as well. These are just check boxes that you mark. And then you use codes to explain what kinds of benefits you sponsor. And so 4A is all of your group health plans that are not dental or vision. 4B is life insurance. 4D is dental. 4E is vision. 4G is prepaid legal. 4F is fully insured short-term disability. 4H is fully insured long-term disability. 4L is other death benefits like a travel accident plan. And then 4Q is other stuff like your indemnity and long-term care insurance. There are a couple of other special codes I want to mention off to the right here. Sometimes an employer is at 100 and needs to file, but they know the very next day the new plan year begins and they're not at 100 anymore. They're under. And so when that happens, what you're going to do on that 5500 filing is use code 4R as well. That's going to tell the Department of Labor, I am filing for the plan year that I had 100 plus, but the following plan year, I didn't have 100. So I'm not going to be filing for this plan year that just renewed. So 4R puts advance notice to the DOL. I'm not going to file this coming year. And you'll hear from me again when I reach 100 again. When that eventually comes around, you have 100 on your plan again. You'll go through the whole plan year, and then 7 months after the year is over, you'll go ahead and do your 5500 filing and use 4S to basically tell the DOL, I'm back. I hit the 100 again. I know I've been not reporting the last year or 2 or 3 or however long it's been, but I am back and I'm filing again. 4S is my code to let you know it's because I went back to 100. Some questions we get is, what if I change my employer name or EIN? There's a place in line 4 where you can indicate what the old name or old EIN was. So the different new employer name and or EIN can do the filing. And in line 4, put the old entity in there. You don't have to go back and revise a prior filing to mark it final and start a new one. You just indicate right here in line 4 This is just a continuation of what we've been doing, just under a new name or a new EIN. Then you're going to attach a Schedule A from each insurance policy being reported. So your carrier is going to give you a Schedule A to attach. And this is what triggers that requirement to provide a summary annual report or an SAR to your employees after you're done. I often get questions about what about Schedule C or Schedule H or I, which are financial statements that depend on group size. You only need to worry about Schedule C or H or I when you're using a trust, when the plan is funded, is what they call it. If you don't have a funded plan, you're not using a trust, you don't need to worry about those schedules. So hopefully that helps clarify why you never see those, is because they don't really apply to most employers. So we hope this is helpful to kind of give you some perspective into what's in your 5,500. Why are some plans included? Why are some plans excluded? Why would a self-insured disability plan be excluded? How come I never see it on my 5,500? Now you have a little bit of insight into some of that stuff if you've been wondering. And by the way, if you go and look at your history at that link at the top and you find out you maybe missed a year or two, there is a delinquent filer voluntary compliance program to get yourself caught up and keep the penalties really low in comparison to what they would be without making that voluntary correction. A missed 5,500 filing is a penalty of over $2,000 a day that it is late. It is substantial. So you really want to engage in that delinquent filer process as soon as you figure out you have a problem. Definitely work with your Hausman team first to make sure you understand if you have a problem or not. But that would be something really important to engage before the DOL comes knocking. All right, I don't see any questions, so we'll move on to the budget reconciliation bill. So we want to focus on the benefit provisions of that bill. It was signed into law on July 4th. It used to be known as the One Big Beautiful Bill. The Senate rules said we can't call it that, so we're just going to call it the Budget Reconciliation Bill, just so we're all on the same page about what bill we're talking about. Some highlights of what it covers: we've got enhancements to HSAs. We have an increased dependent daycare FSA limit. We have some fringe benefit adjustments and some employer tax credit adjustments. So we want to talk through each one carefully. HSAs are up first. This is the stuff that I think people were pretty excited about and wanting to see. So here we are. First up, for 2025, so this is going retro to the start of the year, we now have permanent relief for first dollar telehealth to be compatible with HSAs. So we don't have this temporary relief thing anymore where we can have telehealth and not charge a copay or charge a deductible. We are okay now. We can charge a copay or no copay. We do not have to apply the deductible in an HSA qualified health plan anymore. If you have been making people pay a fair market value for a telehealth visit at the first half of this year, you have options to decide what do you want to do about that. You could go back and reprocess claims. You could just say, hey, we'll institute a change going forward, but we're not going to go back and reprocess claims, or we're just going to wait to implement this at our next renewal. Whatever you want to do with that is totally up to you as an employer, as a plan sponsor, but we have permanent relief now and it is retroactive. So you have options. For 2026, one quick little change I want to talk about with HSAs, and then we're going to move into the big change. A little change is that bronze or catastrophic exchange plans are a new type of HSA qualified plan. It used to be you had to have an HDHP that met some specific criteria, like it can't have any copays before the deductibles met. So bronze and catastrophic exchange plans are now HSA qualified, and they don't have to comply with all those QHDHP rules. This may be of interest to employers sponsoring an ICHRA. If you have an HSA in the mix that you want to allow employees to pay for pre-tax, contribute to pre-tax, previously you had to limit that to employees that go out to the individual market and buy a QHDHP. Well, now you could also extend that to those who choose a bronze or catastrophic exchange plan as well. Now, just a reminder, They can't pay their exchange individual health plan premiums pre-tax through your cafeteria plan, but they could contribute to an HSA if they elected a bronze or catastrophic exchange plan. But the big news that everybody was hoping for, compatibility between QHDHPs and direct primary care. So HSAs can now have first dollar DPC arrangements that do not disqualify people from contributing to their HSA. So there are some limits though. What they decided on in order to make this possible is they really want these DPCs to not get into the nature of what insurance is supposed to do. They want it to be focused on primary care. So there's a service restriction and a cost restriction. Service restrictions, they must consist solely of primary care providers providing primary care services. And some caveats they put on that is we should not be including services that require general anesthesia. The DPC cannot be including in your membership fee prescription drugs other than vaccines. So they can sell prescription drugs to you for an additional fee, but it shouldn't be part of your membership fee. And laboratory services not typically administered in an ambulatory care setting should not be part of your fee. A cost restriction would be that they should not charge more than $150 a month, double that for a family, in order to not be treated as a health insurance type arrangement. And that will be indexed in future years. So we're not going to be stuck at 150 and 300 forever. It's 150, double for a family, and that will index. Now, I do want to caution, this does not mean employer-sponsored DPC is on the horizon. That would still create a group health plan. We would have ACA rules, ERISA rules. It would be subject to COBRA, and it would be pretty complicated to try to make such an arrangement subject to something like COBRA or ERISA. That just seems a little bit out of reach yet. So what we would probably focus on is making sure if you want to encourage people to have a DPC arrangement and they have an HSA, maybe consider a contribution to their HSA if they go enroll in a DPC. That would be a safe, acceptable route to go without sponsoring the DPC itself. Okay. And these DPC fees are reimbursable from the HSA, so that's why funding the HSA works. They are going to be reimbursable now, a reimbursable expense. So all good news there that I think everyone was hoping for, and that starts in 2026. On the dependent daycare FSA for 2026, we have a permanent increase of the $5,000 limit that we've had for almost 40 years. That is going up to $7,500. And we always have half of that amount for married filing separately. So the $2,500 is going to go up to $3,750. This is a permanent change with no future indexing though. So just a caution there that it's a one-time thing. You can lock it into your plan document for next year, and you won't be making any amendments in future years to index it any further. We'll have to wait for another act of Congress to make another adjustment there. But I do want to caution as you think about amending your plans for 2026. A lot of employers struggle with non-discrimination testing failures, especially the 55% average benefits test. If you are already an employer that struggles with this test at $5,000 and you increase your benefit to $7,500, you may find yourself even more out of whack and having more issues satisfying this testing. So it may be worth thinking ahead if you're an employer that struggles with this testing every year and has to reach out to your highly compensated to let them know, hey, I know you wanted to put in $5,000 this year, but I actually have to cap you at a lower amount because I'm failing my non-discrimination testing. Here's your maximum allowance for the new year. If you're an employer that typically runs into that and has to relay that message year after year after year, increasing the highly compensated to be able to contribute up to the 7,500 may make that problem even worse. So just think ahead to that. What do you want to do about it? Do you want to maybe offer 7,500 to everyone but your highly compensated and keep the highly compensated limited to 5,000 or something else? Just think ahead if you're an employer that struggles with the testing. we do anticipate it would make those problems that you're already experiencing worse. If you're not experiencing problems, I wouldn't worry too much about it. We'll see where your testing goes. Okay, some fringe benefit updates for 2026. Education assistant plans. Um, they were allowed to reimburse student loan payments the last few years, but that was set to expire at the end of this year. That is now permanently extended. That's a permanent part of the tax code now. You can include in your 5250 education assistance plan the ability to reimburse student loan payments. Also, that 5250 is going to start indexing after 2026. So that's all good news. We have a new tax favored benefit employers can sponsor. And they're called Trump accounts. They're basically an IRA, sorry. They're a new type of IRA only for individuals that are under 18. So employees and dependents can contribute to this until the year they turn 17. And employers can make a contribution up to $2,500 a year to the Trump accounts of an employee that's 17 or younger, or their dependents that are 17 or younger. And it's $2,500 per employee per year. So even if they have multiple children under 17, my reading of the law is it's per employee. So this will be a written plan under Section 128, and it will be subject to rules similar to the daycare FSA rules that we have under Section 129. And that does include those infamous non-discrimination tests that we just talked about, like that 55% average benefits test. So just a heads up, we need some guidance before we can implement these. But good news, there's a new tax favored benefit for employers that want to sponsor as many tax favored benefits as they can for their employees. This is something new that's coming down the pike. We will have to wait for guidance to see what this looks like, though, because when the law says it'll be subject to rules similar to Section 129, that means, well, we need to know what those rules are. Also, the bicycle commuter benefit was scheduled to come back in 2026, but it is not. That was permanently eliminated from the tax code as we're moving expenses. So, we used to be able to provide some moving expenses tax-free to employees and deduct them as a business expense. That is all subsiding as well. Certain military and intelligence officials can still get the moving expense, but for the bulk of employers out there, that is permanently stricken from the tax code. Paid family and medical leave tax credits are getting an overhaul. They were set to expire at the end of this year. They are permanently extended, and they're trying to sweeten the deal to make more employers interested. Not a lot of employers are taking this up, and they think they figured out some reasons why. So, under the current law, and that will continue through the end of this year, your written policy has to cover pretty much anyone that's worked there for a year, even if they're part-time, and offer to pay 50% of their wages for at least 2 weeks. And that written policy, if you have that, you can then claim a 12.5% tax credit on those PFML wages you're paying. And that increases a little bit for each percent of income that you replace above 50, all the way up to a cap of 25% credit. And you can actually claim this for up to 12 weeks of PFML. What they did is tweak those rules a little bit. New is that employers are able to choose, am I going to continue to just take credit for paid family medical leave wages I pay? Or if an employer that buys PFML insurance, I could instead switch next year to taking a credit for these insurance premiums I'm paying, even if nobody takes a leave. So that might be a new option that you can consider. And then your written PFML policy in 2026 can only cover people working 20 or more hours a week. You wouldn't have to go all the way down under that anymore. And the employer could start taking the credit for PFML they provide as early as 6 months instead of waiting a year. That's an employer option that's available. It also treats leave provided under state or local leave law as part of the written policy, even though you still can't take credit for wages paid under those state or local mandated leave laws. The fact that you have those in place is allowed to count in your favor as having a written policy that covers everyone that it should, all the 20-hour workforce. So that's good news. There may have been some employers that couldn't qualify for taking the credit because they have a statutory requirement in a particular state, and that's a state-run program, so I can't offer anything to people in that state. Well, now this gives you credit for that state-run program too. So all good news there. Employer provided childcare credit is increasing as well. So used to be you could claim a 25% credit to offset expenses for creating or operating a employee childcare facility or contracting with a local one that allots a certain amount of their care spots for your employees, and 10% of qualified childcare and referral expenditures up to $150,000 a year. Now, starting in 2026, that 25% credit is going to increase to 40%, and it'll increase to 50% for small businesses. The 10% for referrals and resource services, that's not changing, but the 25% is going up quite a lot. Also, the cap, 150K, is going up to $500,000 a year, 600,000 for small businesses. And you can have some joint ownership of a daycare facility now, where it used to have to be your own. So a lot of improvements there that might be worth looking into if this is a need that you have for your employees. Provisions we didn't ultimately get. The House had passed some stuff back in May that didn't ultimately make the final bill. We do not get any ICRA changes. So individual coverage HRAs don't get any changes under this new law. Um, there was a proposal to rename them to choice arrangements to shorten the 90-day advance notice period to 60, a 2-year tax credit for non-applicable large employers that would agree to newly sponsor one of these. And they were going to allow pre-tax paycheck deductions for exchange-based insurance plans premiums. None of this happened. So none of that made it into the law. We're stuck with the rules that we've had for some time. We'll see if another bill comes along to maybe work on some of these things. The HSA provisions that were left out, they were going to allow up to 60 days to open an HSA and go ahead and submit all your receipts for expenses incurred from when you joined the QHDHP to when you opened the HSA. That didn't happen, so you really need to have the HSA open day one if you can. They were going to allow HSA compatibility with Medicare Part A, limited on-site clinics, and spouse health FSAs. None of that made the cut, so none of that is in place for now. And then they were going to allow qualified sports and fitness. They were going to allow both spouses to contribute to catch-up contributions to one HSA. They were going to allow extra contributions to an HSA for certain incomes, and they were going to allow some rollovers, some conversions of health FSA or HRA funds for people that have not had an HSA in the last 4 years and decide to newly enroll in one. None of this stuff on screen made it. So all of these are for future bills to try to see if they can resolve and implement. So that is where we ended up with the budget reconciliation bill. A lot of decent changes for 2026 for employers, a lot to think ahead to as you're planning for open enrollment, what you want to sponsor in 2026. Some other summer updates that we had, the Mental Health Parity and Addiction Equity Act had a final rule last September, almost a year ago. That is on pause. So basically, there was a lawsuit, and the new administration came in and said, we tend to agree with the points you're making in the lawsuit. What if we agree to not enforce the law for the rest of 2025 and all of 2026 with respect to these final rules? We'll just hold plans accountable for the rules as they were before that rule was issued while we work out the kinks of this September 2024 final rule and see if we want to make some adjustments. The plaintiffs agreed, the judge agreed, so that's where we are. We're in a non-enforcement environment for that part of mental health parity. We still have mental health parity though, okay? And since 2021, employers should have financial, QTL, and NQTL analyses on file for your plan. If your carrier or TPA will provide it for you, that is awesome. If they won't, they need to at least provide the employer data to go hire a third party to do it, and that is very expensive to get done. It's at least about $15,000, and it is a process. Let me tell you, it takes months and months to get that done. So we do have mental health parity still in effect. It's the changes made in September of 2024 that are on pause right now. And enforcement is not only continuing, but has extra funding. So we definitely encourage employers to be thinking really diligently about this space. When the Department of Labor or HHS has investigated and asked for information, maybe they've had a complaint and they've seen a deficiency, they have made plans go back and reprocess claims. So we have seen autism spectrum disorder claims for ABA therapy have to get reprocessed for multiple years to the tune of tens of thousands of dollars. Obviously, that is more cost than a $15,000 analysis being done for you. So we just want to keep everything in perspective that this stuff does matter to the federal government. And yes, with this administration too, this stuff is a high priority and has increased funding for enforcement. Some recent court decisions we got. The District Court of Northern District of Texas, you know who they are. They come around a lot, and like to upset the apple cart. They struck down the 2024 reproductive health rule that enforced heightened HIPAA requirements for reproductive healthcare PHI. That is now stricken. So employers that don't want to have those enhanced HIPAA requirements can unwind them. Maybe you don't want to have that special attestation form that somebody has to fill out before you'll release PHI to a government agency or local health official. So that's up to you as an employer. Do you want to unwind those or maybe relax those a little bit and go back to the usual HIPAA rules that you usually follow and not treat reproductive health care any differently than other PHI? Also, that day in June, the Supreme Court of the United States ruled that Tennessee had authority to pass a law prohibiting Tennessee healthcare professionals providing certain medical treatments for transgender minors. We have a lot of states in this area now. And so this doesn't really impact employee benefits very much, but some employers may be interested because we have 27 states and counting with a restriction on such services. Some employers may want to look at whether their plan has some travel reimbursement benefits built in, or if they want to add one of their own. We dealt with this post-Dobbs as well. Similar kind of analysis and how do you want to proceed. But just a reminder, gender dysphoria treatment in general, while 1557 and mental health parity rules on this issue may be in flux, they're definitely not crystal clear at the moment. Any employer wanting an outright restriction or exclusion on gender dysphoria treatment really needs to be talking with counsel about it. We do have a decision from about a year ago in Georgia saying it would violate Title VII to have such a restriction or exclusion in your health plan. So for at least that circuit, the 11th Circuit, that decision is out there, and that was at the circuit level. So that was beyond just the district level, that went to the circuit. So that is pretty important decision to not take lightly. So we just want to make sure employers stay protected. Also, the Supreme Court ruled the USPSTF, the task force that comes up with our preventive care mandates, is properly authorized to do so. So nothing changes with respect to non-grandfathered plans having to cover the preventive care mandates at no cost sharing in network. The Supreme Court also declined to rule on Oklahoma's PBM law. It's called Mole Ready is the case. So that leaves intact what the 10th Circuit ultimately decided was that that state law violated ERISA. So many states continue to pass PBM targeted laws. The federal government has not really given us clear guidelines on all of the things that states try to tackle and include in those laws. They've addressed like one thing here and one thing there at a federal level. but not a good roadmap for employers to follow. So if you have questions on this, you got to work closely with your Hausman team and your counsel to try to figure out when ERISA preemption might apply to a law that you don't really like and don't want to apply with. Okay, 2026 adjustments. So we have some indexing for HSAs. Wanted to share that with everybody. We got those in May. And just a reminder that if you have an embedded per person deductible in family coverage, that embedded per person deductible has to be at least as high as the family minimum deductible you see. So 3,400 next year. The out-of-pocket can't be too high, and there is a per person out-of-pocket cap for a non-grandfathered plan. And actually, that number 10,150 went up to 10,600. So I'll make that adjustment. And then the contribution limit for next year is going up as well. For 2026 ACA adjustments, they revised the formula for indexing for some ACA things in June. And so they had previously announced October last year what our out-of-pocket and our ALE penalties would be. Those are adjusted now. So 10,600 on out-of-pocket instead of 10,150, and it's double that for a family. And you can see the penalties are going up about 15% from this year. So quite a jump. 2026 affordability was just announced this week. So we now know next year we could charge 9.96% and be affordable. So for an FPL affordability analysis, calendar year plan could charge up to $129.89 a month for the lowest cost single plan providing minimum value. If you're a rate of pay affordable employer or W-2, you'll just use that percent in your formula. So for example, in a rate of pay arrangement, you use the rate of pay at the start date of the plan year, multiply that by 130 hours to come up with a monthly salary, and then multiply that by the applicable percent for next year. For a plan starting in 2026, that'll be 9.96%. And just a reminder, if you have a non-calendar year plan, the plan you're starting in 2025 has to keep the 9.02% going until the plan year closes. So you're not going to get to jump to the 9.96% until your renewal in 2026. What's ahead? We just talked about July 31st having PCORI and 5500 filing deadlines, but that is also the day that the CHIP model notice gets updated. So as you're looking ahead to open enrollments this fall and you like to provide your legally required notices, make sure you go grab that latest one. August and September is usually when we start to see carriers, health insurance companies provide medical loss ratio rebates to certain policyholders. And so if you're an employer that gets one of these because you had a fully insured plan in 2024 and they decide as a carrier they collected too much premium and need to refund a little bit of that back. If you get such a rebate, make sure to reach out to your Hausman team for how to handle that. Then in October, January 1 individual coverage HRA plans must send out notices at least 90 days in advance, which means you need to get that notice out by October 3rd. All employers with prescription drug coverage need to send Medicare Part D creditable or non-creditable notices by October 15th. And then we do expect all of our other 2026 indexing by the end of October. Think your health FSAs, your commuter limits, stuff like that. Hopefully we'll see all those. And frankly, they've been publishing things pretty early this year. You know, they got that PCORI fee out at the end of May when it's usually 2 weeks into June. They got the affordability calculation for next year out already, and usually we don't get that till August. So they've been running ahead a little bit. So hopefully you won't be going into open enrollment wondering when are they ever going to release the FSA limits for next year. Hopefully we'll see those sooner, but we'll have to see. All right, Cassie, any questions that have come in?
All right, guys, if you have any questions, you can put them in the Q&A, or you can also put them in chat if that's easier for you. Give people a couple minutes, couple seconds here.
Sure.
All right, not seeing anything. You were very thorough. Thank you so much for going over everything, Casey. I know that July 31st is literally around the corner, so if anyone has any last minute questions that they want to send to the team at Houseman Group, or if you want to reach out to Casey directly, we're going to include his information in the follow-up email that you'll get at the end of this, hopefully today or a little bit later tomorrow. Thank you guys all so much for joining live. We do have a survey at the end. Oh, I just see that a question has come through. What would you recommend if we missed prior year PCORI filing?
Talk to your houseman team. Let's make sure we get you the right counts. We do a calculator of what your lowest count is that you can use. The IRS keeps a list of the prior year's Form 720s out there. So you can go to that link and it has all the prior years. You go pick the year that you need and it'll pull up the correct Form 720 for you. You have to use the correct year's Form 720. You can't use this year's. So you have to go back, you'd have to go find the right one, pull that up and populate that. So yeah, work with your houseman team and they'll guide you on the process there.
Thank you very much for answering that. As I was saying, we do have a survey at the end of this presentation. So if you wouldn't mind filling that out, we really are trying to get better at understanding what topics our audience is looking for, especially in compliance. We're very happy to hear what you'd like to learn about, any topics. Nothing is really off the table, so feel free to give us your feedback. We'd love to hear it. And again, have a great rest of your afternoon. Thank you again to Casey, and thank you again.
All right.